Let's shift our focus to company results. Santam, South Africa's short-term insurer, achieved impressive earnings last year despite economic challenges and significant weather-related claims. Headline earnings per share rose 51% to 34.77 rand. Moreover, the company navigated a tough environment with only 1.1% GDP growth, high unemployment and strained consumer finances. The final dividend increased by 8.8% to 9.85 rand, totaling 15.20 rand for the year, and 8.6% rise. Meanwhile, Santam remains optimistic about growth in 2025. Investment analyst Itembile Bupila provides additional insights.
Santam released full-year results, which were in line with recent guidance. Headline earnings per share increased 51% year-on-year, which was actually a little higher than the midpoint of the recent guided range. And we did see this being driven by a solid operating performance, which was in turn underpinned by strategic underwriting actions that leadership has taken to improve profitability, to improve the underwriting margin, which at 7.6% came in much higher than the prior year period, but also came back within the group's target range. So positive takeaway there. All this was achieved against a backdrop of heightened global sort of operating risk, especially the extreme weather-related large loss events that we've seen across the Western Cape, Eastern Cape, and KZN. We'll remember the flood and the large fire loss events over 2023 and 2024. But also the socioeconomic factors that have dampened disposable income and in turn dampened sort of new business volumes for insurers in general. But evidently the group was able to sort of weather these storms, and thanks to the sort of robust performance for the year, they upped the dividend payments up 9% year on year to 985 cents, which was also a positive takeaway from those numbers. And then just looking ahead, management does seem cautiously optimistic about its growth prospects. Economic conditions in South Africa, which does remain their biggest market, are expected to improve over the current year, but they are also quite aware of the sort of prevailing global risks that are at play.